I was listening to a founder talk the other day about getting a huge amount of money. They didn't really need the money necessarily, but they took the offer because they wanted to have the cash on the balance sheet to de-risk the company. It hurt me. Taking a huge amount of venture money adds a lot of risk to your business. It doesn't remove it. The three words in venture capital that annoy me the most, what we see or what I see, there's so much of this presenting anecdotes as data and evidence. I love to try and investigate things and get to the bottom of them a little bit more.
Welcome to Origins, the podcast that dives deep into the business of venture capital, where we learn how the people behind the capital, both GPs and LPs, make decisions. I'm Nick Churls, GP at Asylum Ventures.
And I'm Beezer Clarkson, your LP co-host from Sapphire Partners, where we aim to invest in exceptional early-stage venture capital managers, both emerging and established franchise VCs. And today we're joined by someone who is both very well known in venture and in some ways a little difficult to neatly categorize, Dan Gray. Dan is a researcher and writer focused on venture capital. He's currently the research lead at Odin, which you could consider a sort of, quote, Shopify for private markets, unquote, where his work centers on building better institutional knowledge for the venture industry, particularly for emerging managers. He also writes independently at accredited, where he publishes deep research on fund strategy, risk, and market structure.
Dan also brings a uniquely long-term perspective. He spent nearly 20 years in and around startups as an operator, advisor, and builder across sectors ranging from electric vehicles to fashion to video games. He's also been an angel investor for about a decade. And to give you an idea of his mindset and how he views his work, he recently described himself as being best known for long walls of text on Twitter about the venture industry. But those threads, along with his longer form work, consistently surface insights that help explain where the venture ecosystem actually is today and where it may be heading next.
Should we bring him in and get started?
Let's go.
Dan, we are so excited to have you here. Thank you so much for joining us. And we're just going to jump right in if that works for you.
That sounds great. And yeah, excited to be here. I've been a long-time fan of the show.
Well, thank you. And I've been a longtime social media follower of you. And I presume so has Nick, because when we discussed your name, he knew way more about you than I did. So my assumption is you two are somehow longtime buddies.
I just slid into the DMs.
Yeah, that's how all the best relationships start.
Yeah, exactly.
So last year, you published this survey that was extremely comprehensive about the fundraising low for smaller funds. And your take on it, and correct me if I'm misparaphrasing, wasn't that 2025 was just a hard year. And frankly, 2024 was no fun either. But rather, you're seeing a structural shift in LP behavior. And we're going to link to this in the show notes for listeners. But I was hoping we could start off with this and you could give us sort of the 30,000, 100,000 foot view and then dive in. What do you think?
Yeah, sounds good. I mean, I think the basis of everything I write about is kind of addressing the three words in venture capital that annoy me the most, which is what we see or what I see. There's so much of this presenting anecdotes as data and evidence. So I love to try and investigate things and get to the bottom of them a little bit more. That was the basis of this. Everybody was talking about it's a harder market for fundraising, especially for smaller funds. And that's obvious, I think, in the data, the pitch book data on fundraising, etc. Why, for who, and because of what? These are all interesting things I wanted to look at. So this was with the kind of absolute change as a given, this was an attempt to understand what are the relative changes in the behaviors of different LPs.
Hit us with some of the high notes.
Generally speaking, yes, every GP that responded pretty much said it's been harder. The exceptions would be the GPs who are on Fund 5 plus, the very experienced ones. Even they didn't say it was an easier time, for sure. The shifts in LP behavior, generally speaking, they appear to be making fewer but more concentrated commitments. So when they invest in a GP, they now represent a larger portion of the total commitment, but it's not because their check size is getting bigger, it's because the fund sizes are smaller and the check sizes are the same. So there's fewer LPs per fund, but those LPs represent a bigger percentage.
I'm curious how this might be represented in the data. I kind of think of this market of regardless of size, small, medium, large fund, has become more a market of sort of like haves and have-nots. So even in small universe, at least what I'm seeing is I'm seeing many managers, let's say sub 100, that have what feels like just as much fundraising momentum as they ever have. I agree with you. It's usually maybe a fund 3 or 4. And then a large portion of the market that, is taking a really long time to fundraise. And I see that sort of at the mid scale and the large scale. So I at least what I see in the data is, and this is maybe true in any market, but like top 1% or top 10% chugging along just fine. And then everything else maybe having a harder time. And by the way, I see that in fundraising of startups too. The top 1%, top 10% are, you can see this in the data, like announcing new fundraisers every few months, and big portions of the market then really struggling. Like if you're at, this has been well documented on podcasts, but if you're a startup growing at 2x year over year, early stage startup, like it's very difficult to raise. So I'm curious if you saw that in the data, or if, maybe that's just my little corner of the universe.
Yeah, I think you can kind of get a view on that through looking at, for example, the more friendly LPs. So like fund of funds, or particularly like the founder category of high net worths, which I think are probably more like experimental, more willing to back, fund ones, for example, or less connected managers particularly. So the fall off that's specific to those categories of LPs, which is, more, they've fallen off more than the kind of bigger institutional LPs, probably hurts the have-nots more, which is unfortunate.
How would you describe like the why behind this new normal? My sense is that sort of post-ZIRP era, higher interest rates, people are more discerning around where they put their capital across maybe any asset class. But I'm curious, what some of your research spoke to and found.
Yeah, you've touched on the main thing there, I think. And this is why I bucketed the funds that I looked at into like pre Q2 2022 and post, to really see like what the impact of what that dip was. I think there are like some LPs that are more like liquidity sensitive, like a fund of funds, perhaps they've fallen off quite significantly since then, because like liquidity generally has been problematic. And that's going to impact certain categories of GP more than others. There's also been political stuff too. Like, you've probably talked about the pressure on endowments because of various like decisions that have been made at the political level in the last couple of years. That's another consideration. Family offices dipped a bit too, and I wonder if that's because, like, this is an assumption more than anything. Are they trying to do more direct investing? Is that a consequence of feeling a little bit burned from that ZIRP era? So now they're trying to do more themselves directly, which may or may not be a good thing. But like perhaps that explains why there's been a dip there as well. But that's a bit of guesswork.
Beezer, what are you seeing on the ground?
Oh, on the ground, I echo everything. I think there is a huge challenge given the lack of liquidity. And I think everybody pays lip service to it, but I don't think they appreciate this is a structural challenge to venture capital, that it's a business model that is predicated on liquidity. And so when it's extended out 20 plus years, and there's a whole bunch of LPs who can take, the endowments and foundations are somewhat properly famous for this, having sort of the indefinite or forever timeline, but that assumes other things are going on in their portfolio that can generate liquidity. And if those things get challenged or the stock market changes, it does put pressure on this. And it also means that people assume a certain alpha in the returns when they finally do come. So I would love to have my cake and eat it too, but some of these things just don't work that way when you run the math. So you're really feeling that challenge. And the IPO market being shut in 2025 did not help. Let's just put it that way. And the secondary market, while big, is not big enough for everybody, right?
I'm reading, this is perhaps a tangent, but I'm reading a book called Valley Boy, which is like Tom Perkins' autobiography. And it was a very good reminder that in like the early Kleiner funds, the early Sequoia funds, like they were backing companies and they were going public within a couple of years. I'm just thinking as you were saying that, Beezer, like I maybe hadn't connected the dots, but as an LP in that era, you back a fund, you find liquidity in 2-3 years, and you could use that to reinvest in the next fund. 10-15 years is now not uncommon, at least for early stage. And so you're backing a fund, and then another fund, and then another fund, and then another fund, and then maybe another fifth fund before you're like actually seeing real liquidity. So maybe that just means that the sizing should be smaller, right? If your assumption is you're not going to see capital back, then you have to view like the first few funds as basically one fund commitment. Does that make sense?
Oh, no, it totally does. That's interesting. Because what was also going on back then was that it was not atypical. The average time for an investment, people actually took the investment period and took it as a fundraising period. So funds didn't come back to market for 3, maybe 4 years. So, and to your point, especially in 2020 on, there's annual fundraisers. So you had a lot of money going in and not a lot of money coming out. And it's interesting. The other thing that's been coupled, which is just making this all tough. And yesterday, so this is very recent data. This is still a conversation, which is the companies that raised. Everyone picks on the SaaS companies. I don't love picking on them, but they're an easy conversation to illustrate this. Which is if you're going into the AI era and you had one business model and you had raised during the ZERP era, you had a lot of valuation expansion, right? And now what's the durability of the revenue? What's the durability of your business model? And LPs I had this conversation with every single LP I talked to. I had it again yesterday, which is I'm looking at my portfolio. How much of my TVPI is still not real? And if it's growing significantly less. And now I'm being asked to re-up and do more. And how do I balance all these different tensions? Which is a long way of saying, yes, Dan, we see this in spades.
There's another interesting little piece of that, which is I was looking this morning at some data on like LP compensation, particularly the short-term bonuses and long-term bonuses. And the long-term bonuses are typically calculated based on looking back at the last 3 to 4 years, like the average rolling return. And I think like probably that made more sense 20 years ago. Maybe it makes less sense now. Maybe that needs to change, but like changing these things is difficult.
That is true. The other part of your survey that I thought was fascinating, and maybe even it was just the questions you were asking, because I haven't seen, everyone always asks me, and I don't have a lot of good data, so now I'm going to send them all to you, which is who's participating where and when, and your point about the high net worths rotating out. And also just to give you more compliments on your survey, nobody collects this. Like you can't go to PitchBook, you can't go to Preqin. As much as I would love it, they just don't have the data. You have to ask GPs to tell you. So how you got them to is a minor miracle, but so grateful. Could you just say a bit more what you're seeing? Because I thought it was fascinating to say that institutional fund of funds are leaning in, because my experience predominantly in the emerging manager world is that you have to have institutional fund of funds leaning in for the gross majority of new managers to become established, because the endowment foundation world will do emerging managers, but they do so few and so selectively that can't make the market. But you were seeing a difference in behavior that maybe I'm seeing the same thing. It just wasn't coming out to me the same way. So I was curious what you were seeing.
Yeah, I think the trend there that's interesting, and I actually have a question for you that's connected to this, is the largest, kind of most mature institutional LPs. There may be some volatility in how many funds they've committed to, maybe as a slight rise or a slight drop. But what is clear in the data, I think, is they all have quite a large step up in the number of funds they're anchoring. So when they're in a fund, how likely they are to be an anchor of that fund. That's gone up quite considerably. And I wondered if that is, like, do you think that's a reflection of other LPs looking for that like institutional anchor from a due diligence perspective, or just like a stamp of approval, perhaps?
It echoes to me what Nick was saying about how it's always haves and have-nots, and the haves are just shrinking. And that I don't know if there's more anchoring going on, or it just looks like more anchoring. And how did people define anchoring? Because sometimes you'll see one LP with a significantly larger check, but sometimes it's just the LP that's willing to step up first. And it's not necessarily the largest check, but it's somebody who says, hey, listen, I'm going to help you, notably in the emerging manager land, less relevant, obviously. But say like, hey, listen, I'll be the person who reads your LPA. I'll be the one that does a lot of reference calls. I'll call people proactively on your behalf. So I'm not quite sure what your definition of anchor entails, but I suspect it's tied to Nick's observation because I've always seen that behavior. It just might be more clear now.
Yeah, in this case, it was reported by the GP, like which category was the anchor. But like perhaps you're right, it's maybe a bit like axiomatic where the large institutions are more likely to be like to kind of volunteer to be anchors or to be labeled anchors and treated as anchors, but like actually it doesn't reflect like the check size or the conviction.
One last topic we wanted to cover in some of your recent research is the concept of sort of GP brand or firm brand, which you discussed. So one, I'm curious how you, even just first, like maybe how you define what that even means. And I think you argue that perhaps brand around the firm is becoming as important as maybe even like the investment execution. Yeah, curious how you think about that. Is that now perhaps more a critical component of firm and fundraising than previously? And curious to hear your thoughts.
Yeah, I think if you divide the market into the haves and the have-nots, like the overwhelming marker of the haves is that they have super strong brand around the firm, around the GP or around the firm itself, but typically I think around the GP with newer firms. And that brand really relates to, you know, their network, their expertise, their access. And it's just like a very compelling, very coherent story packaged up to sell LPs. Like I wouldn't say it like necessarily relates to better performance in future. You know, there's pros and cons to all of this that we can get into as well. But I think it is like the marker of the haves is that they really nailed this particularly.
Maybe a question for both of you. Like ultimately, I think at the end of the day, the best way to build a really great long-term brand in venture is to make really good investments. Do you agree with that? Is that true?
Yeah, I'll give you the quick answer, but I'm very curious to hear what Bees has to say on this as well. From my perspective, you know, in kind of like a local market context, the last few years have been like very, very competitive, very concentrated on AI, very access focused. And that's what I think the GP brand relates to, is how do they plug into that? So it's less relevant if you're like, you know, a smaller firm on the periphery investing in really weird stuff, of which there are plenty and they're fantastic. But like if you want to be a part of the, you know, the heat, that's when it matters the most.
I agree on if LPs are defining best as in the best returns, you have to wait, call it 15 years. I mean, maybe there's some early liquidity because some company goes out fast and whatnot, but it's a very long-term definition. I think in the short term, people do look for this access and whose companies are getting markups or follow on, or if there's not markups because they don't need to fundraise, what's going on in the business trajectory that people can look at and say, this manager has shown excellent investment judgment. And that's sort of the LP phrase. And right now, but access is really, my assumption is it also works on the founder side, and that the narrative that one has to tell LPs might have slightly different color to it or variations on it, but how do you get access to the best entrepreneurs? Isn't it, I'm putting this back in your court, Nick, don't you have to tell them a story if you're competing, or get there first and convince them to still take your money and not shop it?
Yeah, I just mainly mean, I'm always confused on like what exactly brand means. It's sort of like a nebulous term. When I think of like great brands in venture, they were largely built on making extraordinary investments in the early days, whether that was Klein or Sequoia, you know, Andreessen's first couple funds, there's been a lot of attention on recently. So you can do all the marketing in the world, but like ultimately, I think the rubber meets the road at some point. You know, maybe that's fund 2 or fund 3, but like you tell me, Bees, are like, I would imagine it's hard to raise a fund 3 or fund 4 if there's not stuff in there that looks really, really promising. And ultimately, founders, I think, as much as you have a great pitch and, you know, maybe you're there first, like entrepreneurs also want to see the companies you've backed, you know, and if you have a really long portfolio page and like they've never heard or seen any of those companies, like that's probably not a great way to win long term.
Dan, what does your research say around this? Because to build on what Nick was saying, there's some sort of very strong big names that seem to have gotten a lot of attention in 2025, the Sequoia, General Catalyst, A16Z. And then how does that work if you're new and emerging? Are there any sort of tells in the research around what these big name funds are doing that continues their success? And at the same time, if there's any tells for the new and emerging managers, because at some point, at one point, A16Z was a new manager, and there are ones even now which I think have done a really good job on landing the messaging and the access, and they're only a handful of years old, TBD on companies, and they're very AI. But I'm in your camp of I love the research, not just the Twitter memes, because those are kind of not even an inch deep, right?
There's like a trend that you can see in every cycle in venture capital, which is it's kind of like the buy IBM meme. Like every time there's a real hard market dip, the firms that come out the best and the fastest are the most well-known brands. And it's not necessarily connected to like whether that means that they've performed well. It's just that they have legacy, they have track record, they have institutional trust. So they tend to bounce back the fastest. I did some analysis a year or two ago looking at previous cycles where essentially the big obvious names that we all think of, whenever there was a crash, they tended to come back the next year and had quite strong fundraising. The rest of the market would come back the year after because it would take them a little bit longer to recover. So my prediction based on that was actually that 2025 would be a great year for emerging managers. Turned out to not really be the case, sadly. Maybe this year, TBD. But like that's a part of it. Obviously, there's not much that emerging managers can learn from that about how they build a sustainable brand with real longevity. The other thing I think the big kind of legacy firms offer is just like the confidence in the story. I think venture capital generally loves a simple, nice, coherent story. They have track record. They offer a great service. Returns vary, but like generally probably pretty good. And that's all you need.
Ezer, what do you work with tons of emerging managers. What do you advise, for an early manager? We're talking about, hard times. Hopefully they get better. Yeah. What do you advise someone that's maybe like, I don't know, quarter or third way through the fundraise? It's taking a really long time. Like, I know it's so manager dependent, but are you telling people just to like stick it out and keep going? The market will get better. Iterate on your strategy or find new partners or close up shop. Like, yeah, just curious. Like, I imagine you've had many of these conversations in the last couple of years and managers come to you. So curious to maybe hear a flavor.
Yeah, I wish there was one answer for everybody, but I do think that the challenges fall into certain consistent buckets, which you alluded to. I think for some folks, they really don't realize how similar their product offering is to somebody else. And I don't know if it gets reflected in how the founders hear it, but the LPs certainly can't differentiate because many of the decks just look the same. And maybe this is the same thing you see from founders, but I think appreciating that an LP has seen a number of these, what really makes you different? And because I'll get called for references and they'll say, what makes Nick different? What makes Dan different? And if they're new managers, they might not have a deep track record. So you can't, it's just not there, and that's fine. But it's it's this insight into X. It's this access into this node of entrepreneurs, and appreciating that we all want to be special unicorns, but we're not the only ones out there. And being able to compare yourself and being true about that, I think, is really important. And then also being smart about who the LPs are that you're pitching. And some only want a certain type of LP, and that LP might not be interested in that kind of exposure, or they might have different timeframes, and just being very smart about sort of the sales motion. And then how you package information. Because I am long on if you have an LP that's going to take whatever you're offering and they're not asking any questions, that's awesome. But for other people, send Excel. Put all the numbers in there. Make it simple. Like, this is not the market to make people work on trying to understand when you invested and what you invested in or what you're trying to say. And some of the basic blocks I think are important. I think there's despite how hard this market is, I'm always struck by how little history people spend time learning and being educated on what some of the best practices are, because they really haven't changed at all as far as I can tell.
Do you think that's true on the LP side as well as the GP side?
And probably, but what specifically are you asking about? I think it's human nature. So yes.
Yeah, that's true. It's the learning from history. It's like, I think it's a fantastic point. It's something I tend to talk about a lot as well. You know, the looking through past cycles, how different categories of firms tend to perform across those cycles is quite interesting. It changes quite a lot, like hot markets versus cold markets, for example. But like, I don't get the impression this is something that a lot of LPs talk about.
Oh, that's such an interesting question. I agree. I think when I've seen, sometimes people do postmortems on why did I miss this fund? What did I not believe to be true? And usually, yeah, you had to take some leap of faith because something about the GP wasn't what was the consensus at the time. Maybe they were, let's just talk about Ribbit, right? I mean, historically, fintech-only funds in the 80s and 90s were not doing great. And when he came along, I think there was a lot of, it's fintech only and he's doing crypto. And I don't know how to digest that in my traditional LP world. And he did, from what I understand, incredibly well. But it was a different option in a pool of things that didn't make sense didn't make sense, but didn't have the historical track record to say this is obvious. So I think a lot of LPs, myself included, have had struggles with that because you have to believe something different about the future. And that's more of the early stage investor direct mindset than it is an LP mindset.
But I think that's important because ultimately that's a very generalizable investment skill, right? Perhaps this is a question for you, Beezer, like to what extent are LPs also FOMOing into the hot AI funds in the same way the founders are FOMOing into, the VCs are FOMOing into hot AI startups? Like, there's groupthink everywhere, is my point. And so, like, Ribbit's a great example, right? Of like, you needed to have some independent conviction on something that looked different. How much are you seeing that in this market now? Like, how much are you seeing LPs just be like, okay, I need more exposure to some hot AI focused fund versus like, okay, maybe we're like later innings of the cycle. By the way, I suspect we are, but that's a highly contested topic. But like, versus LPs being like, you know what, I feel pretty good about my exposure. I'm going to go find some things that look different.
The language that I hear generally is this, like, here's my portfolio and here's where I need more. And for some folks, it is AI because it's so clearly resonant in the market as far as what's been driving TVPI or public stocks, right? So it's both. If you look where innovation broadly speaking is going, and where if you didn't have certain stocks in your portfolio, your publics also do not look great. And LPs get compared to each other, so it's not an irrelevant consideration. But sometimes you find, what I also hear is, it's not always AI then, but what's hard to know is if you're not in AI, and this goes to what you guys talked about early on about the haves and have-nots on the direct side, if you're not an AI company and you don't have those growth rates, who's funding you? And then can your companies make it if people don't want to fund them? So even if I say, I want more XYZ because it balances my portfolio out and I think it's coming back, if it's not going to be successful because the direct investors are going to do it, as an LP, you can't drive that boat. And right now, there's some counterpoints around deep tech and some of those other, not that AI software is not relevant in them, but there are other business drivers. And so I hear that conversation. And it also gets coupled with, just to throw everything in the kitchen sink, I do hear this amongst the LPs that do emerging managers usually look portfolio construction wise and say, what kind of exposure do I want a lot of or less of, given the risk profiles? For folks with established managers, it's a lot of, hey, here's where I think my established managers don't have as much new access because it's the next generation. And maybe I need more exposure to the 23-year-old who's rolling out of XYZ company, and I don't have that. And so it's much more of a point solution, or they call it hub and spoke or whatever the term is, but that's where people are looking to add. And then it does feel very much, what is the next generation? Because it is candidly just hard. I mean, I look with a lot of admiration and fear at how one stays up to date on the next wave of everything in the direct investing land and the hustle that's necessary. And that's always true. It just is really fast today.
Let's maybe look out a little further Dan, I'm curious, so we've described this new normal. Some of the big established brands, LPs fund, buying IBM in a tougher market, some emerging managers, or at least probably the majority of emerging managers, perhaps having a harder time fundraising. What do you think this new normal looks like? Is it new normal as in like a generation or 5 or 10 years? Or what do you think perhaps changes the market in the years to come?
Yeah, I've written about this probably more than anything else. I've tried every single angle to both understand it myself, but also help other people understand it. So it's fascinating to me. I think there was a post from Hadley at ENIAC the other day, and he was talking about that again, the bifurcation, small managers with a certain strategy, and then the big multi-stage giants who have a different risk profile, different return expectations, obviously different LP base significantly. And my response to him was I don't understand why we call both things venture capital. There's such a difference in even if you take it all the way down to the fundamental product, which is risk, and the small traditional venture firm offers idiosyncratic risk, which is the extreme novelty of the companies they back and the extreme outlier potential that they have. On the other hand, the big multi-stage firms tend to offer more systematic risk, which is they believe in a particular category or a theme, and they really go all in on that. But it's more, in some sense, it's removing the idiosyncratic risk because there's more confidence about the category, but there's more systematic risk because the whole thing could blow up if it goes wrong. But it's very clear to me, I would say that the difference between the two is so huge. It's very difficult to justify that they both come out of the same venture capital allocation bucket.
Well, we call them the big banks, the large financial institutions, many of which actually have PE strategies now. And then I agree. I think there's a universe of people that are still actual venture capitalists.
But can I ask a question on this? I appreciate everything you're saying, Dan and Nick, but don't hate me. Does it matter? Because if the big banks, to use Nick's term, and the asylum funds, the dedicated craft of venture folks, are investing in the same company at the same time-ish, call it big seed to Series A on, I as an LP may or may not be putting them in the right bucket in my head, but from a founder perspective and from how the dollars get deployed into the ecosystem, does it really matter? And what does that mean on a go-forward basis?
I would argue it does matter for LPs because the
No, I mean for the founders and for the ecosystem. I get why it matters to the LPs, because if you think you're getting a 3x on your fund and you need $5 trillion outcomes to do it, you could starve the capital eventually, but
the exposure you get to that company through us is dramatically larger.
Okay, say more. That's interesting.
We're putting, let's say, a core investment, 4% of our fund or 5% of our fund into a company at a very early stage. So on a look-through basis, you have a lot more ownership through us than you do through Andreessen.
Wouldn't their check be...
If you're saying they're investing at the same time.
Yeah. Wouldn't their check be... Our math, it's not the same size checks. You guys put the exact same check. Assuming the exact same check size goes in, I get your math. It's going to be a titchy portion of $1 billion seed fund versus your fund.
Well, the risk profile is totally different. From a percentage of our fund basis, right? The risk profile is completely different for us than a large fund that's writing an option check. So I would still argue, even if it's the same companies, you're getting true early stage exposure through a very small, idiosyncratic, craftier fund than you are through a huge platform that's putting call it $20 million on their $3 billion, $5 billion fund. You're actually not really getting any exposure to that company.
And what's been your experience of how that also impacts the company and the founder? Because there's the LP experience, but the venture market's made up of all the different components, right? And if we're going to say, what does it mean if there are these big banks and then boutique craft funds part of what that means, part of what I'm trying to think through in my head is, well, what's the experience on the ground for companies, and how's that going to drive the market?
From my perspective, I think it's tough to compete with multi-stage firms. I mean, they have a lot of advantages. They have bigger brands, and they're often willing to pay the highest price. That's pretty hard to compete with. So in general, I do think you have to be there earlier, and I do think you can actually compete there. I think there's some category of founder that understands the differences and understands the nature of the relationship and the fact that, we have like real capital at stake, and a large multi-stage firm does not, at least for many, many rounds into the future. And then I think there's a class of founder that doesn't care and is ultimately going to just like pick the best known brand at the highest price. Perhaps that's a non-answer. It's a little bit of a generalization, but at the end of the day, I think for an early stage firm, you either have to invest in the thing that's not hot, that the like big firms are not investing in today, or you have to somehow consistently find the founder first.
That's an interesting part. I would add on to what you said before as well about the way the risk changes, which I think is not well understood. Some interesting research about like what happens when a company raises too much money too early, and essentially it makes the future of that company more fragile, because it overinvests in a particular vision, and if that vision doesn't work out, it's more likely to fail. And this plays into like, if you take the same company and you imagine an investment from like a crafty firm like Asylum versus a multi-stage venture bank, that company will have different outcomes based on those two scenarios. The venture bank is likely to invest a lot more. They're happy with that more fragile future where if the company flies, it really flies, but there's also a higher odds of it failing catastrophically. Whereas, and I think you would agree with this, Nick, probably like you're more willing to like go on the journey with the founder and help them figure things out. And the odds of failure are probably lower. And maybe on the margin, that means you don't have as many of the like ginormous, humongous outcomes, but like probably overall, like it's a higher quality strategy.
I can speak for us. We certainly like founders that are willing to go on different paths than, we're okay with some founders obviously going down I need to raise gigantic amounts of money and going really big. But we also like founders, and I suspect the multi-stage firms would be less open to this, that can build companies that are super capital efficient and, don't plan to raise capital. It's always hard to see truly into the future and what a founder will decide to do. And some big multi-stage firm comes along and wines and dines them, and their journey can change. But we have founders that have truly forged their own path and have said no to large venture firms that are building phenomenal businesses with much less dilution than the traditional venture path. Yeah, I think your point is we have some flexibility to invest in founders that are going out and building just really solid capital efficient businesses. Perhaps they're not the, $1 trillion SpaceX outcome, but can fit a fund like ours really, really well. They would not fit a large multi-stage firm. Now the challenge, I think both of you raised this, is like that path in some ways is more difficult. Like it's harder to find capital if you need it. And so if you're serious about that path, you have to be like pretty serious about it and have to plan for it. I think perhaps even maybe from day one.
Yeah, that makes sense. Just as a small like aside to tag on to that, I was listening to a founder talk the other day about getting an offer from a well-known firm, a huge amount of money. And the founder said that they took the offer. They didn't really need the money necessarily, but they took the offer because they wanted to have the cash on the balance sheet to de-risk the company. And it hurt me because like they should understand that like taking a huge amount of venture money adds a lot of risk to your business. It doesn't remove it. It adds it. And again, something perhaps not well understood.
Just one final point on this, and perhaps something that is maybe more difficult to see in the data and the research. But I was talking to a founder yesterday who does want to go down the path of not raising lots of venture money. There are ways in which the business can be profitable very quickly. I'm interested in working with him. He's outside San Francisco. And I said, what happens when some big firm comes and wines and dines you? And he's like, I don't give a shit. I just want to own as much of this company as humanly possible. And I what we both realized, and he has lots of friends in San Francisco and Silicon Valley that built big companies. I think there's a social component too. So I think, for the folks that are in like the belly of the beast and want to go to the fancy Sequoia events, and there is a real like social fabric in San Francisco that is part of life. And so having access to that network and selling off another 20% of your company when you didn't want, for some founders that's a good trade, and it actually improves the quality of their life and their network. Perhaps they don't need the extra money, and that's a good trade. And I think there's, for the founders that are outside that epicenter, it's not a good trade. Yeah. I mean, that's anyway, this is probably more idiosyncratic than anything, but interesting.
No, it's fascinating. I was curious if we could play a little bit and what does this all mean? And we could take the 2026 view, which everyone wants to know what to do tomorrow, or the bigger trend view, because this goes to some of the things we you had written about, we had read about, Silicon Valley, San Francisco as the hub of tech life, vis-a-vis other areas. Will Mandis's write-up about the decline of Boston, which, as someone who grew up there, really resonated, but was probably the 16th thing that I've read on the subject because I'm old as dirt and grew up in the tech era. And my father used to teach entrepreneurship back when entrepreneurship was defined as a 45-year-old who left a firm after 20 years to build something. And Silicon Valley took over in 97, and I don't really think has stopped, right? From my experience. Not that other areas haven't risen like New York, but it still sort of defines what it means to be in venture capital. All of that is the mega backdrop on, Dan, given your research, what do you think all of this means for the experience for folks in 2026? And if you extrapolate it out, given your risk research and trend lines, if you had to guess what it looks like 10 years from now, what would you say? Because I don't know if the mega funds are going away, but maybe we all just have to play together. And I appreciate research versus my sheer speculation. So do you want to take a stab at it and we'll just see what it looks like?
Yeah, it's an interesting one because there's so many moving pieces. Generally speaking, network effects are positive. So that's driven the success of San Francisco, obviously, New York to an extent as well. But they reach a point of saturation. And after that point, it becomes like inflationary. It's less efficient. It's actually becomes a drag on the performance. And I think like probably we're certainly with the AI boom, we're kind of hitting that point with San Francisco. And I think there's this whole question of like the risk of the startup ecosystem being so concentrated there to begin with, and like the connection with this wealth tax problem, that's uncovers like a huge fragility. If that goes ahead, it's a huge problem. So there's already a suggestion that like the ecosystem in the US should be more spread out across other hubs. I think that would be healthy in general. So then the question is that likely? And like that probably depends a bit on how things play out with AI. The research already shows that investments made outside of the main hubs tend to drive more outperformance. VC firms in those hubs tend to be the ones that outperform. So like in San Francisco or New York, but it's the investments that they make elsewhere that have more efficient returns, just from a pricing perspective. It's hard not to see firms looking to do more investing outside of San Francisco, because like at some point, everything is so concentrated with AI there. Like I just can't see it lasting. I can't see that sustaining. And if it does, it seems like an even bigger problem. So it must change. So like in summary, my assumption is 10 years from now, things are more spread out. There's, more investment in kind of industrial tech in Austin, in media tech in LA, in fintech in New York, whatever it might be. Hopefully a resurgence in Boston as well with the biotech. And probably that will be a lot healthier.
I hope that comes to fruition.
I do tend to be an optimist with my predictions.
Thank you so much, Dan. This was great. And thank you, Beezer, for all your amazing insight too. So.
Oh, no, I love it.
Thank you both very much. It's been great.
Thanks for listening to Origins, the show where we discuss the venture ecosystem through the lens of myself, a GP, and Beezer, an LP. Our show is produced by Sapphire Ventures in partnership with Pod People.
Be sure to tune in next time for a bonus minisode where Nick and I unpack our thoughts from today's conversation with Dan and the latest happenings in the market.
You can find that right here in this feed. And while you're there, please rate and review this podcast. No, actually do it. It's very helpful to us, and it's helpful to other folks that are looking to find the show.
You can also keep an eye out for more by following Nick and I, as well as OpenLP on X and LinkedIn. I'm Beezer Clarkson.
And I'm Nick Churls, and we'll be back soon. Thanks for listening.